You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well today. We are going into the world of telecoms this morning. So, got a member asked me about what would be your take on Telus versus Quebecor, and then I thought, well, why don't we just talk a little bit more about BCE Rogers on top of that, like on a side note? Because I was thinking it's a pretty interesting question in the sense where when you're trying to be diversified, you're trying to invest in multiple sectors. And the communication sector has always been one of Canadians' favorite, right? They've been around forever. They offer a good yield, but they also offer a balance between growth and income, which has not been true for the past few years, right? You just have to look at the total return actually for the past 12 months, which is super short term, but Rogers down 27%, including the dividend. So don't tell me, oh yeah, but Mike, you forgot the dividend. Yeah, when I'll talk about total return, I talk about capital plus the dividend. So Rogers minus 27, BCE minus 20, Telus slightly up by 3%, and then Quebecor up by 21. So already pretty big difference between Quebecor and the other three. If you look at 3 years, you're now minus 37 for BCE, minus 34 for Rogers. Of course, Rogers have been on a great decline as of late, so numbers would have been completely different a few months ago. Telus minus 21, so we have minus 37, minus 34, minus 21, and then Quebecor plus 41. Crazy, right? Let's take a look at the 5 years. So now we're having a better trend. Rogers minus 14, BCE minus 6, even if you consider all those dividends. Telus, up plus 37, plus 39. So a little bit better if you look at the past 5 years, but still the past 3 years have been completely catastrophe for Telus. Let's be honest here. But then Quebecor up 55. So 1, 3, 5 years, Quebecor by a long margin. It's going a lot better. So now, if you and looking at stock price, just giving you an idea of how the market is getting some love to one stock versus another, but it doesn't tell you much about if you should invest in a company or not. I mean, it's just second guessing, playing Monday morning quarterback. But I mean, I don't have a time machine, so I cannot sell my shares of Telus 5 years ago, or would have been a very good move 3 years ago and then buy Quebecor. Well, it's impossible, right? So there's not much point to look at that. My point here was more to highlight the fact that when we're thinking about the big telcos, we're thinking about the big three, and they have been quite a failure as of late over the past 5 years, but there's one interesting company in the communication sector, or so it seems, that would be Quebecor. So what I did is I dig a little bit further, and I have a tool at Dividend Stocks Rock where I could just key in all the tickers I want or pull out the entire industry. So that's what I did for this one, to compare face-to-face Telus, Quebecor, BCE, and Rogers, and looking at the metrics, overall metrics, to see if there was one thing that was a big highlight. So one thing that I've noticed, if I look at the 5 years, and I always start with the dividend triangle. So the dividend triangle is a set of 3 metrics that helps me create the foundation of any of my investment thesis. It's a way for me to understand if the business is thriving or not. And of course, if it's not thriving, well, chances are it's not going to be part of my portfolio for very long. So it goes like this. You look at the revenue, and then the earnings, and then the dividend. So it goes by stages. You must grow your sales to make more profit, to share the wealth with shareholders. All right, so looking at the dividend triangle, one thing in terms of revenue that stand out is Bell. Bell, the 5-year revenue is 0.51%, so nothing. The other three, Rogers, Quebecor, and Telus, they're between 5 and 6%, so mid-single digit. all of them. And just to be fair, one other thing that you have to look at once you look at the number over the past 5 years is to look at the graph. If you look at the graph for Quebecor, of course, there was a big boost when they acquired Free Mobile. During the acquisition of, when Roger merged with Shaw, they were forced to sell Freedom Mobile to somebody else, and then Quebecor raised their hands, and then that boosted their revenue. So that explained why they have like a good revenue. For Rogers, of course, is that acquisition, and then for Telus, they made also acquisitions in their healthcare division. They grew agriculture, and then Telus International. So that's where the revenue coming from. Bell didn't do much in those regards, so that's why they have flat revenue. The second thing that stands out, though, even more is in terms of earnings per share. They're all negative besides Quebecor, and that probably explains why. And then you see there's a logic here. Why Quebecor shows their stock price going up a lot faster than the other three? Well, it's the only one reporting almost 5% earnings per share growth over the past 5 years. All the others are down. So Rogers at -4, Bell at -44, and then Telus at -14. So interest charges was a big thing. But still, I mean, Quebecor is still playing around in the same arena, right? So another thing that I did is then you see, okay, so revenue, Quebecor, Rogers, Telus, same place. Bell, definitely behind. Earnings per share, one winner, Quebecor, by like so much. And then a landslide. And then dividend growth, really interesting. Nothing for Rogers over the past 5 years. 4.71 for BCE, but has been nothing for the past 12 months and a little bit more than that. For Telus, 6.69, so almost 7. That has been their motto for the past 5 years. For 25, we don't know how it's going to play out. Quebecor, 27%. Okay, that's crazy. But then latest dividend increase was up 10%. So again, looking very, very good. You look at the payout ratio, they're all like in the 100s right now. And the only one, and then they're going to tell you, oh, you should focus on cash flow. And that's fair enough because there's a lot of like amortization, stuff like that in their balance sheet. But still, interest charges is real money that you're paying out. And Quebecor is dealing very well. Payout ratio around like 43%, cash payout ratio at 37%. So we're nowhere close to all the other companies' metrics. So now, should you move away from Telus and move into Quebecor? That's a very interesting question. In terms of numbers, definitely, if you take out everything else, it seems like Quebecor is a winner. The one thing that prevents me from going after Quebecor is most of their revenue, and then this is where you have to understand the business model and have like the qualitative and quantitative analysis. Quantitative, Quebecor is definitely a big winner. Qualitative, I'm not sure. I'm not convinced because Quebecor is mostly making money from their media business and their cable, and I don't see that as a growth vector. So of course now they're trying to grow a lot faster with their internet and their exposure to wireless. Maybe it's going to play out well, but I don't know. Have a reserve. I'm not saying I'm right, though. I mean, I could be wrong. And definitely the numbers over the past 5 years are telling me that I should have made that move. So that's fine. To be fair, I only have like one stock in the communication sector across all my portfolio, which brings the question, do you really need to invest in the communication sector? And I bought Telus like 10 years ago when it was flourishing and growing. So now I have to revisit it. I've been quite open about this. I'm actually waiting to see what's going to be the next dividend growth policy for the coming weeks, coming years. So I'm expecting this in the next few months, actually. In the meantime, I'm holding still. The metrics are better than BCE, which, I mean, it's kind of like a consolation price, not much. But definitely Quebecor looks interesting. I'm just not sure about the growth perspective. And without the acquisition of Freedom Mobile, that would have been like almost flat. So I'm a bit reserved on that. If you want to see how the stock comparison tool works in action, I'm actually doing a webinar this Thursday on how to clean your portfolio. And I'm using this tool. I'm using this tool to clean up my portfolio, make better decision. See, if I just look at the numbers, it's a lot easier to determine which is the winner or not when you hesitate between one stock or another. So I'm going to make the full presentation there. I'm going to give you a bunch of tricks, and most importantly, a step-by-step methodology to clean your portfolio and make sure you're ready to go through that storm. Don't wait until the storm is over. It's like right now you have the chance of making a better portfolio before the rest of the storm passes. I don't think we're done with a bad market, and this is your chance to make sure that your portfolio is well diversified and robust enough to go through it. So you can register at moosemarkets.com/webinar. The link is also in the show notes as well. So moosemarkets.com/webinar. If you're already on my newsletter, you're going to receive an invite. So it's to clean up your portfolio, getting the 5 steps to do it, and making sure that you take action now before it's too late. So again, moosemarkets.com/webinar. See you on Thursday. Tomorrow, we will be talking about 5 stocks trading at their 52 weeks low. So that could be quite interesting, right? So make sure that you subscribe to the podcast. You give me the 5-star if I think that I give you some value out of it. And until tomorrow, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.